Today's video is all about Dan Ives' latest take on the AI revolution. The Wedbush tech analyst believes AI monetization starts now and that Wall Street is still underestimating the size of the opportunity ahead. In this video, I'll first play Dan Ives' interview uninterrupted, then I'll give you my detailed breakdown and reaction to his biggest points. Finally, I'll share my in-depth analysis of 3 AI stocks that I believe are well-positioned to benefit from this next phase of the AI boom. Now let's hear what Dan Ives has to say.
But what about demand destruction? Does that happen, especially when you see something like Apple come out and across the entire suite having to raise prices?
Sure, look, I mean, there's going to be negatives, just like we see with memory, because there's a limited amount of memory chip players. You can't just all...
So there is a breaking point, though.
There is a breaking point to a point where, like, okay, if you continue at these prices, eventually there's cannibalization, there's churn. For Apple, at these levels, 100 bips of churn maybe. When it comes to iPhone, it'll be a $150, $200 price increase, but then there'll be subsidies from carriers and others. But look, now you're seeing where it's called Ramageddon, or what we're seeing in terms of memory prices. That is gonna have an impact, but I view it as it's paying a small tax on the broader ecosystem that's being built out by big tech.
But if there is a little bit of a breaking point, when does it happen?
Look, I think in the next 6 to 9 months is where you need to see some sort of stabilization when it comes to prices. You need to see scale. You need to see ultimately what we're seeing in terms on the token side, where you need to see like prices start to come down. CapEx will be about $1 trillion for big tech next year, but then the monetization starts. So essentially, you start to actually now see the monetization piece, which is very important to just investors feeling like Meta, they're not just spending like 1980s rock stars for no reason.
There's one story that really caught my attention over the past couple of weeks. It's the idea of Microsoft shifting to Chinese large language models that are open source and that are cheaper. It's the idea of OpenAI pushing back their IPO, and a question of how much OpenAI and how quickly the Anthropics of the world can monetize given the cheaper competition overseas. How much do you see that as a pressure point that hasn't fully been realized or even actualized in terms of people's ideas?
Look, my view, and I think you see with OpenAI and Anthropic, the models eventually will become commoditized. And it's not just OpenAI and Anthropic. You'll have hundreds of models across the world, vertical specific. The value will be in the data, how quickly that they could penetrate enterprise. Microsoft, in terms of Nadella is seeing around the corner, understanding like you have to ultimately diversify when it comes to models, and eventually as it becomes a global sort of game. But when it comes to Anthropic and OpenAI, they understand enterprise is golden goose. That's what they're going after. Now, to some extent, part of the reason that Microsoft, that you see the stock the way where it is, because there's a view like, okay, that becomes competitive. They had OpenAI, but now like where do they sit relative to enterprise? My view is on enterprise, Microsoft will continue to be the ultimate winner, but it just shows it's a convergence what's happening across the AI.
If that's a commoditized resource, the large language models, and it really is the data providers are not OpenAI and Anthropic, well then what's the monetization prospect for some of these companies that potentially are going to IPO at $1 trillion?
Well, for them it's all about enterprise. I mean, if you look at Anthropic's growth, it's been unlike anything we've ever seen in terms of ARR. Now for OpenAI, it's a bullseye on their back. They have to continue to monetize in the enterprise, because enterprise, when you think about all the data centers being built and all the memory and everything, it's being built for what will be the use cases on enterprise, on the consumer. Software vendors, in my opinion, are the ones that it goes back to the second, third derivative, just like cybersecurity. So I think part of where I think investors, and I don't think it's reflected in the stocks, is like they're underestimating the scale and scope of what this is all going to look like. And I think we've talked about it. It's like party start at 9 p.m., goes to 4 a.m., it's about 11 p.m.
Can you monetize a model that's currently restricted?
No. And that's why when it comes to Anthropic, that's why they're starting to play nice when it comes to government. You're seeing some sort of, compromise, or at least some moving of the goalposts. And that's important, because Anthropic right now, I mean, you're talking about the best model in the world. You cannot be on relative to what we see on the DoD and the Pentagon. That's why it's an important time for Dario and Anthropic to get to some sort of compromise when it comes to U.S. government.
One of the first topics Dan addresses is something that doesn't get talked about nearly enough, and that's demand destruction. Everyone has been focused on exploding demand for AI chips, data centers, memory, and cloud infrastructure, but eventually someone has to pay for all of it. The interviewer brings up Apple as an example, asking what happens if Apple is forced to raise prices across its entire product lineup because the cost of AI hardware keeps increasing. Dan acknowledges that there absolutely is a breaking point. He explains that if prices continue climbing indefinitely, consumers eventually begin delaying purchases or simply deciding not to upgrade. In Apple's case, he estimates that a $150 to $200 increase in iPhone pricing could eventually create some churn. Not a catastrophic amount, but enough that investors should pay attention. Now, I actually think this is one of the healthier conversations we've heard in the AI space recently. Sometimes it feels like investors assume demand will stay unlimited forever, but history tells us that's rarely how markets work. Every technology boom eventually runs into questions about affordability. Whether it was personal computers, smartphones, cloud computing, or electric vehicles, there always comes a point where customers begin asking whether the extra cost is worth it. The good news is that Dan doesn't see this becoming a permanent issue. Instead, he describes today's higher costs as almost a temporary tax that consumers and businesses are paying while the AI infrastructure gets built. That analogy actually makes a lot of sense. Right now, every major technology company is racing to build out data centers, purchase GPUs, expand networking infrastructure, and secure enough memory to power the next generation of AI applications. Those costs naturally ripple through the entire ecosystem. But over time, efficiencies improve, production increases, competition expands, costs begin falling. We've already seen this happen countless times throughout technology history. Another point Dan makes that really caught my attention is his timeline. He believes the next 6 to 9 months will be incredibly important because investors need to begin seeing stabilization in pricing. Token costs need to continue declining. Infrastructure has to become more efficient. Hardware needs to scale. And perhaps most importantly, companies have to begin proving that all of these massive AI investments are actually generating meaningful revenue. This is really where I think Wall Street's mindset is changing. For the past couple of years, investors have largely given companies a free pass to spend enormous amounts of money because everyone understood we were in the infrastructure phase of AI. Now we're entering the monetization phase. Dan mentions that big tech could collectively spend around $1 trillion on capital expenditures next year. Think about that number for a second. $1 trillion. That is an almost unimaginable amount of investment flowing into artificial intelligence. But eventually investors stop asking how much companies are spending. Instead, they start asking what they're earning. Dan even jokes that investors don't want companies spending like 1980s rock stars forever. And honestly, I thought that was one of the funniest, but also most accurate comments in the entire interview. Meta, Microsoft, Amazon, Alphabet, and everyone else can justify enormous capital spending today because investors believe those investments will produce massive returns tomorrow, but that belief cannot last forever without results. Personally, I completely agree with Dan on this point. The AI narrative has reached the stage where execution matters far more than promises. The companies that can demonstrate real revenue growth from AI products are going to separate themselves from the companies that simply continue talking about future potential. The conversation then shifts toward one of the biggest strategic questions in artificial intelligence today. What happens if large language models themselves become commodities? This is probably my favorite part of the interview because Dan challenges one of the biggest assumptions many investors have made over the past few years. Instead of believing that only a handful of companies will dominate AI forever, Dan believes we'll eventually have hundreds of capable models around the world. Some will specialize in finance, others in healthcare, others in manufacturing, others in legal services, others will be open source, others proprietary. Eventually, having an intelligent model may no longer be enough to create a lasting competitive advantage. Instead, Dan believes the real value shifts somewhere else. It shifts toward the data. It shifts toward enterprise adoption. It shifts toward distribution. And honestly, I think he's probably right. Technology history usually follows this exact pattern. The underlying technology eventually becomes more accessible. The companies that own the customer relationships often become the biggest long-term winners. That's exactly why Dan keeps emphasizing enterprise customers throughout this interview. Enterprise is where recurring revenue lives. Enterprise is where switching costs become incredibly high. Enterprise customers have proprietary data that cannot simply be copied by competitors. enterprise relationships often last for years. That combination creates incredibly durable businesses. This is also why Dan remains so optimistic about Microsoft. One of the interviewer's questions revolves around reports that Microsoft has explored integrating lower-cost open-source Chinese AI models alongside its existing AI partnerships. Some investors immediately viewed that as a sign that Microsoft's relationship with OpenAI was weakening. Dan doesn't see it that way at all. Instead, he views it as smart strategic planning. He points out that Satya Nadella understands AI as becoming a global ecosystem. No company should depend entirely on one model provider forever. Diversification actually strengthens Microsoft's competitive position because it gives customers more flexibility while allowing Microsoft to adapt as AI technology continues evolving. Personally, I think that's exactly the right way to approach it. The companies that remain flexible usually outperform the companies that become locked into one specific technology. Microsoft has always been exceptionally good at adapting to industry shifts, and AI appears to be no different. Another fascinating discussion revolves around OpenAI and Anthropic. Many people assume these companies could eventually be worth close to $1 trillion. Naturally, that raises an obvious question. If AI models become commodities, how do companies like OpenAI justify trillion-dollar valuations? Dan's answer comes back to growth, specifically enterprise growth. He points out that OpenAI's annual recurring revenue growth has been unlike almost anything we've ever seen. That growth explains why investors remain so excited, but going forward, expectations become much higher. OpenAI now has a target on its back. It has to continue expanding inside enterprises. It has to prove businesses are willing to pay. It has to show customers continue increasing their spending over time. In other words, the hard part is only beginning. Building an incredible AI model is one achievement. Building a sustainable trillion-dollar business around that model is something entirely different. I think that's an important distinction that sometimes gets lost in all the excitement surrounding artificial intelligence. History is filled with brilliant technologies that never became equally successful businesses. Commercial execution matters just as much as technological leadership. Dan also makes another observation that I found particularly interesting. He believes software companies could become some of the biggest winners from the AI revolution because they're second and third-order beneficiaries. I couldn't agree more with that view. Most investors naturally chase the obvious names, the GPU manufacturers, the hyperscalers, the model developers. But some of the largest long-term returns may actually come from software companies quietly embedding AI into products that businesses already use every single day. If AI dramatically improves productivity across customer service, finance, healthcare, cybersecurity, legal work, engineering, and countless other industries, then software companies gain enormous pricing power while making their platforms even more valuable. Sometimes the biggest winners aren't the companies creating the technology, they're the companies finding the best ways to monetize it. One analogy Dan uses really captures how optimistic he remains. He says investing in AI today is like arriving at a party that started at 9 o'clock and doesn't end until 4 in the morning. Right now, according to him, it's only around 11 o'clock. In other words, despite all the excitement we've already witnessed, despite the incredible stock market gains, despite the enormous capital spending, he believes we're still relatively early in the overall AI cycle. Whether you agree with that outlook or not, it's certainly consistent with how many long-term technology investors continue viewing this transformation. The final topic focuses on Anthropic and its relationship with the United States government. Dan explains that Anthropic may have one of the most advanced AI models in the world, but if it remains restricted from working with major government agencies like the Department of Defense and the Pentagon, then its monetization opportunities become much more limited. That's why he believes Anthropic has started taking a more cooperative approach with regulators and government organizations. Government contracts represent enormous long-term opportunities. Defense, national security, healthcare, scientific research, intelligence. These are all areas where advanced AI could play an increasingly important role over the next decade. If Anthropic wants to become one of the defining AI companies of this generation, gaining broader access to those markets becomes incredibly important. Overall, I thought this was another outstanding interview from Dan Ives because it reflects how the AI conversation is maturing. The debate is no longer about whether artificial intelligence is real, or whether companies should be investing aggressively. That debate has already been settled. The questions investors are asking today are much more sophisticated. When do costs stabilize? Who captures the enterprise market? Which companies actually monetize AI at scale? And which business models prove durable once AI becomes widely available? Those are the questions that will likely determine the next generation of winners in this AI revolution, and they're exactly the kinds of questions every long-term investor should be paying close attention to. Now let's dive in and break down 3 AI infrastructure stocks that could be among the biggest winners as artificial intelligence enters its next chapter. For years, investors have focused almost entirely on the companies designing AI chips or building large language models. Every chatbot, every AI assistant, every enterprise application, and every new model being trained requires an enormous amount of electricity. That means the companies supplying the equipment that delivers and manages that electricity could become some of the biggest beneficiaries over the next decade, and that's exactly where our first company comes in. The first stock on today's list is Eaton, ticker symbol ETN. When people think about artificial intelligence, Eaton usually isn't the first company that comes to mind. In fact, many investors still think of Eaton as a traditional industrial company. I actually believe that's one of the biggest reasons why this stock remains so interesting, because underneath the surface, Eaton has quietly become one of the most important companies enabling the AI infrastructure boom. The company specializes in intelligent power management. Its products help move electricity safely and efficiently throughout commercial buildings, factories, utilities, and increasingly massive AI data centers. Without companies like Eaton, the AI revolution literally cannot scale. You can have the fastest processors in the world, but if you can't reliably distribute enough electricity to thousands of GPUs operating simultaneously, those processors become useless. That makes Eaton one of the purest infrastructure plays available for investors looking to capitalize on AI. And the financial results strongly suggest that demand is accelerating. As of the end of June, Eaton shares were trading around $422 and had already climbed roughly 29% year-to-date while delivering an incredible 198% return over the past 5 years. Those gains are impressive, but what excites me even more is what's happening inside the business. Eaton's Electrical Americas segment, which has become one of its biggest growth engines, reported organic orders increasing 42% on a trailing 12-month basis. That's an extraordinary growth rate for an industrial company. Revenue in that segment reached $3.6 billion, representing 20% year-over-year growth. Perhaps even more impressive was the company's book-to-bill ratio of 1.2. For investors unfamiliar with that metric, a book-to-bill ratio above 1 means the company is receiving more new orders than it is completing. In simple terms, demand is growing faster than production. That's exactly what long-term investors want to see because it creates future revenue visibility. Even better, Eaton's total electrical backlog jumped 48%. That tells me customers are placing orders well ahead of time because they know demand remains incredibly strong. And honestly, that's one of the strongest signals investors can look for. Companies don't build huge order backlogs unless customers are confident they'll need those products months or even years into the future. Eaton also delivered another earnings beat. Adjusted earnings per share came in at $2.81, ahead of analyst expectations of $2.73. That marked the company's 4th consecutive earnings beat. Consistently outperforming expectations tells me management continues executing at a very high level, despite operating in an environment where supply chains remain challenging and customer demand continues rising. Perhaps even more encouraging was management's decision to raise full-year guidance. The company now expects organic growth between 9 and 11%, while increasing adjusted earnings guidance to a range of $13.05 to $13.50 per share. Companies don't typically raise guidance unless they're seeing continued strength in customer demand. That confidence should definitely grab investors' attention. One of the biggest developments during the quarter was Eaton's aggressive acquisition strategy. The company completed approximately $11 billion worth of acquisitions, including the massive $9.55 billion acquisition of Boyd Thermal. Now, why is that acquisition important? Because thermal management has become one of the biggest challenges facing modern AI data centers. As processors become more powerful, they also generate far more heat. Traditional air cooling is no longer sufficient for many next-generation AI systems. Liquid cooling is becoming increasingly important because it allows higher performance while keeping equipment operating safely and efficiently. By acquiring Boyd Thermal, Eaton significantly strengthens its position in one of the fastest-growing areas of AI infrastructure. I actually think this move was incredibly strategic. Rather than waiting years to build those capabilities internally, Eaton immediately positioned itself as a much stronger player in advanced cooling solutions. That should enhance its long-term competitive position as AI deployments continue expanding globally. Chief Executive Officer Paulo Ruiz summed up the company's momentum quite well when discussing the strength of Electrical Americas. He pointed to strong organic growth while highlighting ongoing investments to expand production capacity and meet customer demand. That tells me management isn't simply enjoying today's demand. They're preparing for tomorrow's demand as well. Another number that really stood out was free cash flow. Free cash flow increased an incredible 245% year-over-year to $314 million. That's important because free cash flow provides companies with flexibility. It allows them to invest in new factories, pursue acquisitions, reduce debt, repurchase shares, or increase dividends. Speaking of dividends, Eaton also rewarded shareholders by increasing its quarterly dividend to $1.10. That combination of strong growth and rising shareholder returns makes the investment story even more compelling. Wall Street analysts also remain optimistic. The average analyst price target currently sits around $455, with 22 buy or strong buy ratings compared to only 6 hold ratings. That level of institutional confidence reflects just how strong Eaton's position has become within the AI infrastructure ecosystem. Of course, no investment is completely risk-free. One concern investors should monitor is the company's aggressive acquisition activity. Completing $11 billion in acquisitions within a single quarter naturally increases debt levels. Net interest expense more than tripled from $33 million to $106 million, placing some pressure on reported earnings. The company is also planning to spin off its mobility business during the first quarter of 2027. While that could unlock additional shareholder value over the long term, major corporate restructurings always introduce execution risk. Management will need to execute that transition carefully while continuing to meet growing customer demand. Personally, I view those risks as manageable compared to the size of the opportunity ahead. The reason is simple. Artificial intelligence is still in the early stages of its infrastructure build-out. Every new AI data center requires enormous investments in electrical systems before a single AI model can ever be trained. That's exactly where Eaton thrives. The company isn't dependent on one specific AI model winning the race. It doesn't matter whether enterprises use one software platform or another. Every data center still needs reliable electrical distribution, intelligent power management, and increasingly advanced cooling technologies. Those are needs that aren't going away anytime soon. As AI spending continues climbing toward that projected $1 trillion level over the next couple of years, I think companies providing the essential infrastructure behind the scenes may quietly become some of the biggest long-term winners. And Eaton has already demonstrated through its financial results, growing backlog, expanding product portfolio, and strong management execution that it's positioned to capture a meaningful share of that opportunity. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second company on our list, because if you think supplying electricity to AI data centers is exciting, wait until you see the company helping generate the power those facilities need in the first place. The second company on today's list is Caterpillar, ticker symbol CAT. Now, if you've been investing for a while, you probably know Caterpillar as the global leader in heavy construction and mining equipment. It's a company that's been around for nearly a century and has built one of the strongest industrial brands in the world. But what many investors don't realize is that Caterpillar is becoming an increasingly important player in the AI infrastructure story. Why? Because AI data centers don't just need electricity. They need reliable, uninterrupted power 24 hours a day, 7 days a week. A single outage at a hyperscale AI data center can cost millions of dollars while interrupting critical workloads. As these facilities continue growing larger and more power-intensive, operators need dependable backup systems and prime power solutions capable of handling enormous electrical loads. That's exactly where Caterpillar comes into the picture. The company has become one of the leading suppliers of large reciprocating engines, gas turbines, and power generation equipment used to support some of the world's biggest data centers. As AI infrastructure spending accelerates, demand for these products is rising much faster than many investors expected, and the company's latest financial results show exactly that. Caterpillar shares have delivered extraordinary returns, trading around $1,066 while climbing approximately 81% year-to-date and an incredible 171% over the past year. Those gains might make some investors wonder whether they've already missed the opportunity. Personally, I don't think it's that simple. Yes, the stock has had a tremendous run, but sometimes exceptional businesses deserve premium valuations when they're benefiting from powerful long-term trends. The key question isn't whether the stock has already gone up. The real question is whether earnings can continue growing fast enough to justify those gains. Based on the latest results, the answer appears encouraging. The biggest highlight came from Caterpillar's power generation business. Revenue reached approximately $2.82 billion during the first quarter, representing 41% year-over-year growth. That's an incredible number for an industrial business of this size. Even more impressive, this follows another 44% growth quarter previously, suggesting this isn't simply a one-time spike in demand. The momentum appears sustainable. Management specifically attributed much of that growth to increasing demand for large engines and turbines supporting AI data center applications. That tells us something extremely important. We're no longer talking about theoretical AI infrastructure demand. We're seeing real purchase orders, real revenue, real earnings growth. The broader power and energy segment also performed exceptionally well. Revenue climbed 22% year-over-year to approximately $7.03 billion. Those numbers reinforce the idea that AI infrastructure spending is creating ripple effects throughout multiple industrial sectors. Caterpillar also significantly exceeded Wall Street expectations. The company reported earnings per share of $5.54 compared to analyst estimates of $4.64. Beating earnings expectations by that wide of a margin demonstrates just how strong current operating conditions remain. Another encouraging sign was management's discussion surrounding backlog. Chief Executive Officer Joe Creed highlighted robust order activity alongside record backlog levels. That's exactly what long-term investors want to hear. Backlog provides visibility into future revenue because it represents work that's already been committed by customers. As long as backlog remains strong, investors gain confidence that future production and revenue should remain healthy. One aspect of Caterpillar's investment story that I particularly like is its commitment to shareholder returns. During the first quarter alone, the company returned roughly $5 billion through share repurchases, while also distributing approximately $700 million in dividends. On top of that, Caterpillar recently announced another dividend increase, raising its quarterly payout to $1.63 per share. That combination of capital appreciation potential, share buybacks, and growing dividends creates an attractive package for long-term investors. It shows management remains confident not only in today's business, but also in future cash generation. However, I think the biggest reason investors should continue watching Caterpillar has very little to do with quarterly earnings. It has everything to do with where the AI industry is headed. Remember what we discussed earlier in the video. Hyperscaler capital expenditures are projected to approach $750 billion this year before potentially exceeding $1 trillion next year. Every one of those massive AI campuses requires dependable power generation. As electrical demand continues climbing, backup generators become mission-critical infrastructure rather than optional equipment. I actually believe this could become one of the strongest long-term investment themes of the AI era. When most people think about artificial intelligence, they picture software engineers writing code or massive GPU clusters processing billions of calculations. Very few people stop to think about what happens if the electricity suddenly goes out. AI cannot function without reliable power. That's why companies supplying that infrastructure occupy such valuable positions within the ecosystem. And Caterpillar has spent decades building expertise that competitors simply cannot replicate overnight. Its global dealer network, engineering capabilities, manufacturing scale, and long-standing customer relationships create meaningful competitive advantages. Those kinds of advantages tend to compound over time. Of course, investors also need to understand the risks. One challenge facing Caterpillar is rising manufacturing costs driven by tariffs. Those higher costs place pressure on profitability within certain business segments. The company's Resource Industries division experienced a 39% decline in profit year-over-year alongside meaningful margin compression. While that segment isn't directly tied to AI infrastructure, it does remind investors that Caterpillar remains a diversified industrial company with exposure to multiple economic cycles. Another point worth monitoring involves dealer inventory. Some analysts have noted that higher dealer inventory levels may have contributed to stronger quarterly results. If end market demand slows unexpectedly, those inventory levels could eventually normalize, creating some temporary pressure on future sales. Still, I think it's important to keep these risks in perspective. Every investment comes with uncertainties. The question investors should ask is whether those risks outweigh the long-term opportunity. In Caterpillar's case, I believe the structural growth created by AI infrastructure spending has the potential to remain a powerful tailwind for many years. As long as demand for AI computing continues expanding, demand for reliable power generation should expand alongside it. That's a relationship that's difficult to ignore. One interesting observation is that the average Wall Street price target currently sits below the stock's current trading price. Normally, some investors might view that as a warning sign. Personally, I see it a little differently. Analysts often adjust their price targets after companies have already demonstrated sustained earnings growth. Sometimes the market recognizes changing fundamentals before Wall Street fully updates its assumptions. That doesn't guarantee future upside, of course, but it does suggest analysts may still be catching up to how significant the AI infrastructure opportunity has become. When I look at Caterpillar today, I don't simply see a construction equipment manufacturer. I see a company that's quietly becoming an essential supplier to one of the biggest technological transformations of our lifetime. The market often rewards companies solving critical problems behind the scenes. Reliable power generation is about as critical as it gets. As more AI facilities are built across the globe, companies capable of supplying dependable energy infrastructure could remain in very high demand for years to come. That's exactly why Caterpillar deserves serious consideration from investors looking beyond the obvious AI names. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final company on today's list is GE Vernova, ticker symbol GEV. If Eaton represents the electrical infrastructure side of the AI boom, and Caterpillar represents the power generation side, then GE Vernova sits right in the middle by helping modernize and expand the electrical grid itself. And in my opinion, that puts the company in an incredibly strong position over the next several years. One of the biggest misconceptions surrounding artificial intelligence is that building more data centers is simply a matter of finding land and installing servers. In reality, one of the biggest challenges is getting enough electricity to those facilities. Many regions simply don't have the grid capacity to support these enormous AI campuses. Even if you build the data center itself, it doesn't accomplish much if there isn't enough reliable electricity flowing into it. That's why grid modernization has become one of the most important investment themes tied to artificial intelligence. Governments understand it, utility companies understand it, hyperscalers certainly understand it, and GE Vernova is benefiting directly from that shift. The company has become a major supplier of electrical equipment, grid technologies, and gas turbines that help utilities and large commercial customers expand electrical capacity. As AI continues pushing electricity demand higher, companies like GE Vernova become increasingly important. The latest numbers show just how strong that demand has become. Shares were trading around $1,135, while climbing approximately 69% year-to-date, and more than 113% over the past year. Those are incredible returns for an industrial company. But once again, the real story isn't what the stock has already done. It's what the business itself is experiencing. During the first quarter alone, GE Vernova booked approximately $2.4 billion worth of equipment orders, specifically tied to data centers. Think about how significant that is. The company received more data center equipment orders during a single quarter than it generated during all of the previous year. That's not gradual growth. That's acceleration. And acceleration is exactly what long-term investors want to see. The company's electrification segment also delivered outstanding financial performance. Revenue increased 61% year-over-year to approximately $3 billion. Even more impressive was the book-to-bill ratio, which approached 2.5. Earlier in the video, we talked about how a book-to-bill ratio above 1 indicates growing demand. Well, 2.5 is extraordinary. It means new orders are arriving at a pace dramatically faster than the company is completing existing work. That kind of demand doesn't happen by accident. It reflects customers rushing to secure equipment needed for major infrastructure projects. Overall, company orders surged 71% organically to $18.3 billion. At the same time, backlog increased by approximately $13 billion in just one quarter. Those are numbers that immediately grab investors' attention because they provide visibility into future revenue growth. Management also demonstrated confidence by raising full-year financial guidance. The company now expects revenue between $44.5 and $45.5 billion, while projecting adjusted EBITDA margins between 12 and 14%. Free cash flow guidance also increased to between $6.5 and $7.5 billion. Those are impressive targets, but what really stood out to me was management's longer-term vision. By 2028, GE Vernova expects revenue to reach approximately $56 billion while targeting adjusted EBITDA margins of around 20%. That's an ambitious goal. Of course, management teams always like to present optimistic long-term forecasts, but what makes this one more interesting is that current order activity appears to support those expectations. Chief Executive Officer Scott Strazik highlighted another important milestone. He stated that the company now expects to reach at least 110 gigawatts of combined gas turbine backlog and slot reservation agreements by the end of 2026. That tells us demand for reliable power generation continues strengthening alongside AI infrastructure investment. Personally, I think this is one of the strongest signals investors should pay attention to. Order backlogs often reveal what's happening months or even years before the financial statements fully reflect it. Customers don't commit billions of dollars to long-term infrastructure projects unless they have confidence those assets will be needed for many years. And right now, demand appears incredibly robust. Wall Street also remains optimistic. The average analyst price target sits above $1,200, while the overwhelming majority of analysts maintain buy or strong buy ratings. The company also doubled its quarterly dividend to 50 cents per share, giving investors another reason to pay attention. Now, as attractive as this story sounds, investors also need to understand the risks. The biggest challenge currently facing GE Vernova comes from its wind segment. Unlike the electrification business, which is benefiting tremendously from AI infrastructure spending, the wind division continues struggling. Organic revenue remains under pressure, and management expects approximately $400 million in EBITDA losses from that business during 2026. That's certainly not ideal. Investors should also remember that reported GAAP earnings received a significant boost from a large pre-tax gain related to the Prolec transaction. That means headline earnings looked stronger than underlying operating profit alone would suggest. Those are important factors to keep in mind when evaluating the company's financial performance. Still, when I step back and look at the bigger picture, I believe the positives continue outweighing the negatives. Artificial intelligence isn't simply creating demand for faster computers. It's forcing an entire modernization of electrical infrastructure across the economy. Power generation, grid expansion, transmission equipment, electrification technologies. These aren't temporary trends. They're becoming essential components of the AI economy, and GE Vernova sits directly at the center of that transformation. Looking across all three companies we've discussed today, I think what's most interesting is that each one benefits from a different part of the same long-term trend. Eaton helps distribute electricity safely and efficiently throughout AI facilities. Caterpillar helps generate reliable power to keep those facilities operating around the clock. GE Vernova helps expand and modernize the electrical grid needed to support the enormous increase in electricity demand. Together, they represent three different ways to invest in the AI infrastructure boom without relying solely on software companies or semiconductor manufacturers. That's something I think many investors are still overlooking. As we move through earnings season, one of the biggest metrics I'll be watching is order growth. Can Eaton continue growing its electrical backlog? Can Caterpillar maintain strong demand for its power generation business? Can GE Vernova continue booking billions of dollars in new electrification projects? If those trends remain intact, then the AI infrastructure story becomes even stronger. Instead of simply being a future investment thesis, it starts becoming a measurable financial reality. That could provide these companies with another powerful catalyst heading into the rest of the year. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd love to hear from you. Which of these three companies do you believe has the strongest long-term competitive advantage in the AI infrastructure boom? Do you think Eaton's leadership in electrical infrastructure, Caterpillar's growing power generation business, or GE Vernova's grid modernization opportunity offers the greatest upside over the next 5 to 10 years? Let me know your thoughts in the comments because I'd love to hear your perspective. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.